This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So let's go through and talk about this other component of equity figure. Essentially, what you've got is, if you go back to the days of F7, in F7 we looked at revaluation gains on PPE, didn't we? And any gain went to a revaluation reserve within equity. When you had there your fair value through other comprehensive income financial assets, those gains went into a reserve, didn't they, within the equity section? They didn't go to retained earnings, did they? It was a separate reserve. And what we're going to do is, your other component of equity is essentially, it's very literal. It's a component of equity that is anything other than retained earnings, share capital, and that's it. Okay, so you'll have share capital, retained earnings, other components of equity, and it groups together revaluation gains on PPE, revaluation gains or losses in terms of fair value through other comprehensive income financial assets. Okay, and the way in which we do it, it's nothing all that spectacular. The key bit that you have is that in the group accounts, it's treated in exactly the same way as your group retained earnings. So you take 100% of P plus P share of S's post-acquisition movement. So what we're going to have to go through and do is, as we'll see, it's key that we look at working two and we start to look at the post-acquisition movement in total and split that out into what belongs to other components of equity and then what belongs, if you like, to group retained earnings. Okay, so there's just a little cheeky calculation that we need to play around with there. Okay, other than that, I think it's quite tricky to get a grasp of it to start off with, but once you've done one or two questions and it crops up in the exam, it's one of the easiest things to do in terms of scoring marks. Okay, so what you've got, again, similar question to the last one. So Luke, a public limited company, operates in the manufacturing sector. Sorry for not being so creative, but keep it simple. The draft statements of financial position, again for the 31st of December 2015, are as follows. And you've got there, is it Luke and Han? Okay. Again, let's just go through that, read the additional information, or before we do, I think we'd be better off reading the requirement. So it wants us to prepare the group statement of financial position of Luke. So Luke must be the parent for December 2015. Given that we've got Han as the other results, then presumably Han is the subsidiary. And I think if we look up there, that's the case, isn't it? 1st of January, start of the year, we acquired 80%. So therefore, Han is a sub. Okay. The cash consideration that we paid was 5,400. Again, we'll need to see if that matches up to the investment figure to eliminate it. At 1st of January, the net assets had a fair value of 3,400 million. The retained earnings were 600, and now other components of equity were 400. Okay, so just a little bit different now. We've got this other component of equity. The excess in fair value was due to an item of non-depreciable land, so that's hopefully familiar from the last example. The fair value of the net assets is different to the book value, and that difference is due to land, so some more PPE. Okay, here non-depreciable, so that makes it a little bit easier, doesn't it? The fair value of the NCI acquisition was 700 million, so we're actually given the fair value of that 20% NCI interest, which is quite handy because they value the NCI, is it there, at fair value. Okay, excellent. So there we go. So what we're going to go through and do is we're going to start off with the workings again. So we're going to look at S's net assets at the reporting date. So here, share capital, retained earnings, nothing new there. However, you do have this other component of equity. Okay, so we'll need to incorporate that as part of the net assets. So head it up, is it there, our workings. We're going to go through there and put in working 2. Again, we're going to look at that, is it at the reporting date. At year end to you or I. At acquisition. and then post-acquisition. The key bit that you've got now is, yes, we have share capital, yes, we have retained earnings, but now we have this OCE, other component of equity. And we know as well, don't we, that we also will have a fair value adjustment. Okay. So the reporting date figures, nice and simple, always come from S's SFP, so copy and paste exercise. 2000, 1000, 625. 2000, 1000, 625. Okay. Share capital at the reporting date is then the same as at acquisition. That will never have changed. The sub will never have issued any shares since the date of acquisition. Retained earnings, other components of equity, are they there? Is it 600 million and 400 million respectively? So we have 600, we have 400. Same exercise as before in terms of our balancing figure for the fair value adjustment. What is the fair value of the net assets at year end? At acquisition, it's 3,400. So we're told that we have 3,400. Does that give me a balancing figure? Is that of 400? Again, we're not told anything different. So that fair value stays at 400. There is no depreciation because we do not depreciate land. Okay, excellent. Net assets at the reporting date, is it 4025? It gives me a post-acquisition figure, is it of 625? Now this is where you need to be careful, because that movement in the net assets isn't just entirely due to movement in profits and retained earnings. You need to split it out. Other component of equity, the movement there is 225. Okay. What you then have, the remainder, the balancing figure, if you like, that is due to retained earnings must then be the 400, isn't it? Okay. That's the balancing figure. In fact, I'll remove the equal sign. Don't just do retained earnings at reporting date, less retained earnings at acquisition. You need to consider other movements as well that influence retained earnings, things such as PUPs, depreciation, contingent liability adjustments. So just take the total movement of 625, deduct the movement in OCE to then give you the movement, if you like, then in retained earnings. Okay, excellent. We then move into working number 3, which is your goodwill. So again, that's the fair value of the consideration. So essentially how much we paid. And here, the amount we paid was 5,400, wasn't it? We then add on the non-controlling interest. The non-controlling interest is at fair value. So we've gone through and looked at the amount paid. The non-controlling interest at fair value was 700. And then I just go through and deduct the fair value of the net asset to acquisition. It was given to us within the question. It's also in our working too, which is there as 3,400. Gives me there is that 2,700. Okay, so that's my goodwill. Okay. Again, remember, that's the fair value of NCI. So technically, that's your full goodwill, isn't it? i.e. the parents and the non-controlling interest share. Okay. Then what we've got, working number 4. Remember, working number 4 is the non-controlling interest. So we take the non-controlling interest at acquisition, which we know from working 3 is 700. And then we add on our 20% share of the movement in net assets from working 2. Don't worry about the split of other components of equity and retained earnings. Those two movements combined give you the total movement in the subsidiary's net assets, isn't it? So we can just take the total figure of 625 at the bottom there from working 2. Okay. So 625 times 20% is that 125. So that gives me, is it 825. Okay. So nothing different there just yet. Now it just gets a little bit different. So what you've got there, working number 5, is your group retained earnings, isn't it? I'll just abbreviate it to GRE. So we put in 100% of the parent. 100% of the parent's retained earnings is 3,200. To which we then add on 80% of the post-acquisition movement of retained earnings. So that's the change, isn't it? Here, the retained earnings movement is 400, not the 625. So 80% of 400 coming from working 2 is that 320. Okay. There's nothing else to adjust for. There's no pups, there's no associate, there's nothing else within there. So you have 3, 5, 20. Yep, excellent. Okay. Working number 6 is your group other components of equity. So that's the important aspect. Okay. So what you've got there is you put in 100% of the parent's other components of equity, which is 1,000. To which you then add on our 80% share of the movement in other components of equity. So back to working 2, the movement in OCE was 225. So 225 times by 80 is 180. Which gives me 1,180. Okay, so I think as F7's evolved, you've seen maybe a little bit more of that. But for those of you who haven't done F7 for a long time, or maybe you've forgotten how to do it, that's so important. Why? Because that's just ridiculously straightforward. Okay, looking at the movement in other components of equity, there's not going to be any changes or any challenges to it. It's nice and simple. So you can get one straightforward, easy mark for putting in our share of the other components of equity movement in the sub. Okay. Yeah, it's as simple as that. Who says P2 is hard? Yeah, there are lots of easy hidden marks around there. Once I've done that, I can then go through and start to look at the group statements of financial position. So what we've got here is it the property, plant and equipment? If I can move it up, being a bit slow, but there we go. So you've got your PPE, we can add those across 3,650 and 2,480. Do not forget the fair value adjustment. Was that 400 from working 2? I'll double check. Yep, 400. It was the land. Land is not depreciated. And again, as before, you've done the working and the calculation. That's 1 mark. Okay. I personally think that the more you do that, that should be particularly easy. Okay. There's no excuses. Sounds harsh, but it's true. So that gives you there is that 6530. We've then got, was it the Goodwill? So Goodwill working 3. If you remember that, you've done well. 2700 on my Goodwill. I think I'll try and squeeze them in because it makes it easier. Inventory, receivables, and cash. Okay. So inventory 1950, 1480. No adjustments in terms of pop adjustments. So does that give me 3430? Receivables 1780 and 1090. I always feel as if I'm wasting your time doing this because in the exam you'd score no marks, but I'm training you to be an accountant, so let's do it properly. And the cash 370, 285. Uh, 370 plus 285 gives me 655. There we go. Okay. Excellent. Again, it's worthwhile noting, isn't it, that the investment of 5400 we ignore because that is the entire investment in HAM, the subsidiary, isn't it? Okay. So total it up. You don't need to within the exam because you don't get any credit for it, but let's just check everything works. So does that give me, is it 16,185? Okay. Hopefully it will balance up at the end. If it doesn't, forget about it. Okay, we don't need to worry. So then what we've got is the equity section. So again, we start off there. Is it with the share capital, which is 100% of the parent only. So 5,500. We then have retained earnings, which is working 5. You then have other components of equity, which are working 6. It's imperative that you split those out. It's easy marks within the exam. So group retained earnings 3,520 and 1180 OCE. So 3,520 and 1180. Okay. Does that give me 10,200? So that is the amounts that are attributable to the parent. Okay, it's everything that the parent owns. Okay, and then you've got the non-controlling interest, the NCI, which was working for 825. Okay, so I can put in my 825 there. Does that give me 11,025 as your equity? Okay, all good. Yeah, this whole example, fairly basic, fairly straightforward. It's all about that there, isn't it? Other components of equity, I suppose, as well. Valuing the NCI using fair value to give you the full goodwill. But we've seen that before at F7. Okay. To finish it off, I need to complete the SFP, don't I? With the liabilities. So I've got non-current liabilities of 500 and 240. Does that give me 740? You've then got, I think, and I'll check, you've got your trade payables. And also, is it a tax payable? Okay, your tax payable and trade payables. There we have it. Trade payables 1900 and 1020. So 1900 plus 1020 gives me 2920. Careful. And then on my tax payable, 1050, 450. So 1050 plus the 450, 1500. It's at this point you sat there in the exam thinking, oh, I wonder if it balances. Don't bother. It doesn't matter. But let's do it anyway and check that we're happy. So you've got, is it 11025? There's the equity plus 740 plus 2920 plus 1500 gives me 16185. Okay. I'm too scared to look. But there you have it. Okay. 16185 on the assets. 16105 on the equity and liabilities. But it doesn't matter if it balances or not within the exam. The likelihood is it won't balance, but you don't get marks for having a statement of financial position that balances. You get marks, like we've demonstrated, for putting in the adjustments and the numbers. So again, if you're going back to the statement of financial position, the PPE, you get 1 mark for that adjustment there. Likewise with the goodwill, that would be at this moment in time, before it gets any more complicated, 3 marks maximum, wouldn't it? Okay, and those 3 marks there are essentially 1, 1, 1. Okay. Again, we've gone through there and shown you other components of equity. I thought that was pretty easy in the grand scheme of things, just looking at the movement of other components of equity from the acquisition date to the reporting date and taking our share. So the 80% of 225 gives me 180, which is so straightforward. Okay, so there's lots of easy marks floating around within the group account. So it's important that you keep practicing the questions, because not only will you get familiar with how to answer them, but you'll also get familiar with the style. Okay, so as it scrolls down there, you can see once again that all the information to do with the group accounts is at the start of the additional information. It tells you the percentage ownerships, it tells you the net assets, it tells you retained earnings, other components of equity, it tells you about fair value adjustments, it tells you what the non-controlling interest is measured at, how it's measured. If there were to be impairments that we move on to shortly, you will see that there as well. Okay, so if you can do that bit, you can then score really well within the rest of the exam. Okay, so other than that, I'll see you all within the next little session.